Hi everyone. For those of you who don't know me, my name's Steve Fletcher, and on behalf of all the team at GSFM and Munro Partners, thanks very much for joining the webinar today. I'm very pleased to have with me Nick Griffin. Welcome, Nick.
Welcome. Thanks, Steve.
Now, the goal of the presentation today really is just to provide you with some fun information that you can share with your clients. We're going to email you this presentation and all the material post the webinar. And the webinar is going to run for around about sort of 30 to 35 minutes, and then that'll be followed by your questions. So please, if you have a question during the webinar, put the question into the Q&A box, and we'll make sure we get to that question at the end of the formal part of the presentation. So I suppose just sort of setting the scene, as we all know, 2022 hasn't been the year that we'd all hoped for in equity markets. The past 10.5 months have been particularly difficult for equity investors, and it's been a volatile ride. We've witnessed already this year multiple bear market rallies. The month of September, just gone, was the worst month for the S&P since the COVID lockdown in March 2020, while the past week has been one of the best weeks since the US summer rally back in July. So I think from all of that, clearly it's been a very difficult market to navigate. So what we've asked Nick to do today is to talk through how he and the team have been managing during these conditions. As you know, a differentiating feature of the Munro Global Growth Fund compared to its long-only counterpart, the Munro Concentrated Fund, is its ability to use a range of risk management tools, such as currency hedging, shorting, put options, increased cash levels, etc. So Nick's going to talk about how these have been utilised in recent months and how these tools could be used in the short term, especially around the currency hedging with a soft $8 right now, and potential short opportunities with a weakening global economy. Now, these tools all help smooth the investment journey for the investor. However, ultimately, it's Munro's stock ideas and their stock selection and stock picking capability that drive the majority of the returns in the Munro Global Growth Fund. So Nick, again, will talk about current positioning of the key areas of interest within the fund and share with you some stock ideas that the team at Munro have been working on and are really excited about today. So Nick, with that, there's a lot to get through. So I'm going to hand over to you, and we'll do some questions after your session. So thank you.
Yeah, thanks very much, Steve, and thanks very much everyone for dialing in. We appreciate your support and interest today. And yes, as Steve mentioned, there's a lot to cover. So I'll keep my introductory comments very, very short. I know a lot of people have seen this before, but I just want to remind everybody that Munro Partners was set up to be your global growth investor. Our funds are designed to fit global equities within your portfolio and fit the growth bucket. Our tagline is invest in the journey with Munro Partners, because growth equities, is a volatile ride. We have a 16-year track record with our investment process of double-digit returns per annum after all fees and expenses. But unfortunately, that's not a straight line. It never has been. It never will be. It is always a journey, and that journey that has bumps in it, and we're clearly in one of those bumps right now. And we're happy to talk about that. So just as a really quick reminder, Munro Partners, it was established in 2016. We've done double-digit returns for our funds since inception. We run roughly $5 billion in assets under management. And our goal is, as I said at the start there, to be your global growth investing. So we're going to be talking a lot about global equities. We're going to talk about growth equities. The team, just to remind everybody, is based here in Melbourne, Australia. We have 23 people in total, and we have 2 in Canada. The important thing, just to remind people on the team and just to remind people on the call, is we do run a partnership at Munro Partners. So our business is we own and control 75% of our business. We attract staff to our business by giving them equity in our business for free. Once you work at Munro for a little while, you effectively get equity for free, and you earn salary and profit share for a while. The day you leave, you have to give that equity back. We think this is the best model to run a funds management business. It's a model that we have effectively mimicked of some of the best fund managers in the world, like Gifford or Wellington or Bridgewater. And so from that point of view, I just wanted to flag that to remind people of the great staff that we get to attract here. And so a couple of good additions in the last 12 months have been Mike Harut, who's our responsible investment manager, who's come across from the Australian Council of Superannuation Investors and prior to that, the Future Fund. And also Hugh Flanagan, who's come across from UniSuper as our head dealer. And you should expect this slide to continue to build out. And so As a business, we will continue to grow this partnership and continue hopefully to attract great people, which ultimately leaves us all rowing in the same direction, which is the direction of obviously the returns that you look for in your clients, but also, the way we communicate with you. Third thing I just want to remind everyone before we kick straight into it is we run 3 products here at Munro Partners today. There is the Munro Global Growth Fund. That is our absolute return fund. That's the fund that ultimately runs at around a beta of 0.7. And that's the one that Steve talked about with the tools, et cetera, that we have to smooth returns. And notably, we raised a lot of cash in that fund in January, and a lot of people have been asking me when we're going to put the cash to work. We'll talk a bit about that today. And that's our product that takes up roughly 70% of our assets. The second product we run is the Munro Concentrated Global Growth Fund. So this is the long-only version of the same thing. So just the long equities without the shorts or the currency hedging or the capital protection tools. And, if you think this is the bottom of the market, that product is there fully invested and for you to invest in today. And the last product, and which I won't spend much time on, but happy to touch on in the Q&A. And I think there's another webinar coming up in a month or so to talk about the Munro Climate Leaders Fund. And this is very much a thematic fund. It's one where we're trying to identify the great enablers of decarbonisation, the companies that we think will help enable this next big mega trend, which is decarbonisation. It's a long-only product also, and it's important to remember that it's very much a satellite product. So you should think about this like a bit like a tech fund back in 2005, but there's no point starting a tech fund in 2022 because it's not the next big thing. The next big thing is decarbonisation, and so that's what we started. And then lastly, just to remind everybody who's tuning in, all 3 funds are now quoted on the Australian Stock Exchange as managed ETFs, and so you are free to buy and sell them as you please, depending on what your view is of global growth equities or decarbonisation equities. Those are the 3 products. That is effectively our business. Last quick introductory slide, which I'm just going to remind people because we're going to get back to this obviously at the end, and I think it's what we've talked about. Obviously, we're in a very difficult macro environment, and I will cover that very quickly at the start here. But we will spend some time talking about this. Look, at the end of the day, our goal at Munro Partners is to look at the global equity universe, to identify the companies that are growing, and then most importantly, identify the companies that are structurally growing. It is these structurally growing companies that basically can grow their EPS over time. That EPS growth ultimately equals share price growth. And even though we are in a difficult macro period, nothing's really changed here. The world will still change into the future. We will still attempt to decarbonize the planet. We'll still need high performance semiconductors. We'll still be innovating within the healthcare area. And so all of these structural areas of growth are still exactly the same as they have been for the last 16 years. These areas of structural growth that we focus on is how we go about finding these companies that can grow structurally over time. They structurally grow their earnings, and their earnings structurally grow their share price. That is your path to the double-digit returns we've produced over the last 16 years. And everything else is just smoothing the bumps along the way. And clearly we're in a bumpy period, so I'll talk about that, but I don't want people to forget that because we're definitely going to be talking about that at the end. And ultimately, this is turning into an opportunity-rich environment. And it's important just to remember that these structural trends are still happening, and there are still companies out there that will actually benefit from them. And what you're getting here is actually just a really good opportunity to invest in them. And so we'll keep coming back to this at the end. I have skipped a lot of investment process there. Please use the website if you want to go back and cover all of that stuff. But as Steve said, this is very much an update webinar, so we'll just skip forward to our view on the market. And so that question around cash. Why did we raise the cash? What are we going to do with the cash? When are we going to invest the cash? And where are we going to put the cash into the future? And so from that point of view, I think it's important to take a sort of a big step back here and just think about how we ended up in the mess that is 2022 in the first place. And so this is just a very simple slide that we use to sort of remind people of what the investment environment is. And so if you look over the last 50 years, you'll see that US 10-year bond has basically fallen from 12% all the way to 0. And in that time, we've racked up a whole bunch of debt. This is US total debt outstanding. And so in my entire investment lifetime, essentially what happens is something goes wrong, we lower interest rates and we raise more debt. Something goes wrong, we lower interest rates and we raise more debt. And so from that point of view, in every single cycle, you end up with a lower peak in interest rates. We think that is still valid today. And so even though inflation is back and some people will convince you that rates should go to 10 or 12%, they don't need to go there. They just need to go to 3 or 4. That's enough to slow the economy and eventually slow rates again. And so from our point of view, rates should be lower into the future than they were previously. Why? Because there's heaps of debt in the world. There's just way too much debt in the world. What's gone wrong is inflation came back. We've got inflation in the economy for the first time in roughly 30 years. And I'll be the first to put my hand up and say there's been some big lessons learnt this year. The biggest lesson I've learnt, and I think most central banks have learnt, is there's no such thing as transitory inflation. Transitory inflation doesn't actually exist. What we've seen is a number of supply shocks that have basically coming out of COVID, and those supply shocks have ultimately made inflation ingrained. The story that I've told, and I've told this a bit, so I apologise if you've heard it before, but in my travels this year, I happened to be in Edinburgh in August. If anybody knows what's happening in Edinburgh in August, it's the festival, the Fringe Festival. And the garbologists or the garbos had gone on strike for the entire month of August. So the whole month of August, they'd effectively decided to go on strike and let the rubbish pile up in the street. The rubbish piled up, the whole city stank. There's rats effectively running down the main street. And the reason why they had is because they wanted a 10% pay rise. And they wanted a 10% pay rise because inflation was 10%. And you could tell them that it was because of the war in Ukraine or supply chain all you want, but they still wanted the 10% pay rise. And I think the mistake that we have made and others have made is to think that inflation was transitory. And the Fed clearly made this mistake. And so the reason why we are in this mess is so essentially that the central banks are horribly behind the curve. This is not new news to most people listening. But what I'm showing you here is effectively the scale of it. This is what central banks thought they were going to do with rates in the next 2 years, back in March 2021. Here in Australia, Philip Lowe thought rates would be zero for the next 3 years. This is what they thought by December. This is what they thought by June, and they're actually now up here somewhere around 5%. Why did this happen? It happened because we didn't know how COVID was going to disappear. Okay, so this time a year ago, for instance, here in Melbourne, we were still in lockdown. Less than 10,000 people were allowed to go to the Melbourne Cup. It feels like an eternity ago, but it was less than a year ago. And what effectively happened is as we came into that Christmas period, the Omicron variant came along. The Omicron variant meant we went away for Christmas. Everyone effectively got COVID. And by the time we got back, COVID was over. And by the time we got back, it was very clear that central banks were miles behind the curve. And everybody knew that rates had to go up. And ever since, we've been basically fighting this problem. Rates have to go up quickly to tackle this inflation problem. And at the same time, asset prices are falling. This is the fastest backup of rates I've seen effectively in my lifetime. And I think most people on the phone, most people on the webinar, would be the same. Not only has it happened to short-term rates, but it's happened to long-term rates. And of course, this has caused untold damage to asset prices globally. This is just a good pictorial way of thinking about what the rate rises will do. The first thing that rate rises do is it obviously lowers the discount rate. Raises the discount rate. As you raise the discount rate, you effectively implode asset values. This started with growth equities at the start of the year, but it's since moved its way into property prices, moved its way into private equity, moved its way into infrastructure. The second thing that rates will obviously do is it will slow the economy, and it will slow it fairly dramatically. The problem the equity market is struggling with is most people on this call who've done year 10 economics know that there is a 6 to 9 month delay after rate rises. And the Fed is about to just do its fourth 75 basis point rate rise in effectively 4 or 5 months. So the economic damage of these rates rises is clearly still in front of us. It's clearly still in front of us. And what you're seeing the market do is effectively try to price this in. Try to price in what's the peak level of rates and how slow will the economy get off the back of this. And this is why you get this, as Steve mentioned at the start, there's quite schizophrenic nature in the market where on one day you might think this is going to be disaster and the next day you'll convince yourself that there's going to be a soft landing. But the problem is none of us really know because we're effectively on the precipice or just sort of rolling into this slowdown today because those rate hikes are only just starting to bite today. And so from our point of view, the reason why I told you that whole story and the reason why I'm sort of finishing on this slide here, which basically says, are we there yet? Is this is essentially a process. It's a process that's been running now for 9 months. And it's a process that was basically caused by COVID. It was basically caused by the fact that we just pumped too much money into the economy during COVID, and now we have to take it all out. And COVID has effectively created a cycle where there otherwise wouldn't have been one before. And most of us haven't had to deal with a decent cycle for at least a decade. And so when you think about this cycle, this is a good way to thinking about, are we there yet in terms of the market? Has the market bottomed or could it go a bit lower? And when we look at this at Munro, we're just simply looking at the maths. And so what we're showing you here is this is the S&P 500 since 2016 to today, and the purple line is the P multiple over that time horizon. And on the left here, this is the S&P 500, 2016 to today, and the purple line is the blended forward EPS of the S&P 500. And so the good news is equity markets, just like my MasterCard slide, effectively follow earnings. You know, companies that make more money every year, the share price generally goes up. The market generally makes more money every year because it's the best 500 companies in the year, and so it generally goes up. But in periods like this, it can go down. And the reason why is because we started the year at roughly 22 times earnings. 22 times earnings. Why? Because we thought interest rates would be lower for longer. We thought that 1% might stick around. It didn't. It's gone back to 4. And so the PE multiple has to drop to take account of that. So we've gone from 22 times back to 16 times. So we're effectively at the right point on the PE multiple. That's the good news. The bad news is the earnings clearly have to slow down. And this is why you get the schizophrenic nature in the market, because we really don't know by how much. We're only seeing signs of what that slowdown is going to look like. But 2023 is probably going to be a down year on the whole for earnings. And so the simple math you can do is 240 of earnings for the S&P right number, or is it 220, or is it 200? And so all the market's doing is saying 16 times P of 220 should equal an S&P of roughly 3,400. 16 times 200 should equal an S&P of 3,000. Most people are doing this maths, and most people can see that, you know, there's still potentially a little bit of downside here. But the other thing to importantly point out is the market has done a good job of pricing a good chunk of this in already. Now, there is a scenario where we're already at the bottom of the market today. That scenario would have to be that, i.e. the bond market's wrong, i.e. the 4% is too high and the 4% is about to collapse to 2, 3 or 2% very quickly, and this PE multiple will go back up again. Or the second scenario is these companies could actually navigate this environment much better than everybody thinks. And both of those are entirely plausible. We're definitely not taking them over the table. All we're saying on this slide is, you know, risk reward. You know, the market actually isn't giving you a great opportunity to invest here. Mathematically, it looks okay. It doesn't look amazing. And normally in these environments, you will get that opportunity. And so we've had a couple of short goes at it back in June and September. But from our point of view, it still feels that mathematically you might get a better opportunity than this. And so risk reward, we haven't actually put all that cash back to work yet today. And so what are the 3 things we're waiting for to basically get this equation to look a bit better? The 3 things we're waiting to are, the first is the most important one. We want long-term interest rates to peak, okay? So what's been doing most of the damage here is interest rates backing up from 1 to 4. It's that PE multiple I showed you earlier. That's been most of the damage that we've been dealing with so far in the market. And so from that point of view, this is actually very close. We actually even thought this had happened in July, and it's probably happening right now. At some point, interest rates do enough damage to the economy that bonds actually rally. And that point is probably being reached right about now. And so that's a big tick from our point of view. The second thing you need is obviously these earnings estimates to come down. Most people know these earnings estimates are going to come down, so that's fine. The question is we don't know how deep it's going to be. Normally the market will bottom, not when the earnings estimates have bottomed, but when you can actually see the other side of the valley. And that's usually between 30 and 50% of what the total EPS cuts could be. And we'd argue today we're probably only at about 15 to 20% of what the total cuts could be. So that one's not quite there yet. The last one is the most important one, is just time. From our point of view, your average bear market lasts about a year, falls 37%. This one's lasted less than a year, and its peak was down 28% for the S&P. And so from our point of view, we do think it makes sense just to be a little bit prudent here. Yes, you know, you can create an equation to say the market's bottomed already, but usually at these points in time is when something else goes wrong. You know, rates have backed up far enough that the tide's gone out, as Warren would say, and you will see who's not wearing any bathers. And so we saw glimpses of that in the UK about a month ago, and I suspect there's other glimpses to come. And so from our point of view, we just want to be a little bit prudent around this and a little bit patient and just say, yes, we can see good opportunities here. And yes, we can see good opportunities to invest in many companies we're talking about, and I'll talk about that in a second. But we don't think this is an all-in opportunity today, I suppose, is a simple way of saying this. And so from that point of view, we're happy to be prudent about this because we have tried to manage the volatility here for a while and managed it reasonably successfully in the last couple of quarters. And we're sort of okay to miss the bottom as well. And so from that point of view, maybe just I'll skip forward a few slides and just talk about what we've been doing about this in the fund. and talk about some of those tools that Steve was mentioning. And then I'll cut back and talk about where we're putting the money. So importantly, as I said earlier, the Munro Global Growth Fund is an absolute return fund. So the absolute return fund has some of these tools, and this is where we have effectively raised some of the cash. If you skip forward to this slide here, this just shows you the net and gross exposure of the fund since inception. That net and gross exposure, as most people know on the call, can drop, as it did here dramatically in 2018, and as it did here in 2020. And again, as I talked about earlier, as it did here in January. And so in all of these scenarios, we're generally either raising cash or using things like put options, etc. We're generally not selling the whole fund and buying it back again. We're just effectively hedging it. In this case, as many people know, we came into the start of the year reasonably fully invested and got caught by this Omicron thing I was talking about earlier, the fact that COVID had just gone away in the space of weeks. By the second week of January, we chose to raise roughly 40% cash. We've been sitting on that 40% cash since January. And essentially, we've been running the long book at roughly 60% for the rest of the year. So the long book has stayed very stable at roughly 60, 65% all year. And the only reason this is going up and down so dramatically in between is because we're lifting our short exposure and then covering our short exposure, lifting our short exposure and covering our short exposure, or more importantly, hedging things like Jackson Hole, etc. And what we're doing there is essentially just trying to add a bit of value. And so I know people are looking very closely at things like these numbers, and they're looking very closely at how we finish September, for instance. And so at the end of September, they see this net 40 number, they see this 60% cash number, and they think, wow, these guys are running a lot of cash. The answer is we're not actually running that much cash. The gross exposure is roughly 80%. The long book is still 60 to 65, as it has been all year. The difference is just what we're doing with the short exposure. We're dialing the short exposure up, and we're dialing it down. This worked very successfully for us through August and September, and you can be pretty well assured that we've had to cover some of these shorts fairly quickly here in October. And so this number today is effectively back at 60% quite quickly. We have had these big bear market rallies that Steve talked about. They do make it hard to short, but we have managed to add value short selling this year. We've added value on the put options this year, and we've also added value on the currency. The last thing we just point out is on the currency in particular here, some of that value we've added on the currency, we've started to bank. And so for most of the year, we normally run the fund roughly 50% US dollars, 50% Australian dollars. This number was 60 and this number was 40 not long ago. We've now flipped that around to now covering roughly 60% Australian dollars and 40% US dollars. Why? Because the currency's fallen a lot, and we've managed to offset some of the long losses with the currency, and we want to lock that in. And we do think around 62 cents was a good place to at least start that process. Putting this together, this is the performance of the fund since inception and the performance of the fund this year. And so pleasingly, we have managed to maintain a double-digit return since inception. So we are still doing more than 11% per annum since inception in the 6 years the fund's been around. And importantly, we're actually doing that, near the bottom of the third bear market since we've been running the fund. The other thing people will notice that obviously we did get a bit caught out in January. At the end of the day, we did come into the year expecting a slower rollout of COVID and a slower back up in rates, and that inflation would never become the problem that it became. This was the wrong view. Ultimately, we had to use our internal stop losses to adjust, and we've adjusted quite quickly. And so I'll talk a bit about some of the stocks that left the fund through that period and also the year before. But ultimately, since the January to February period, we've managed to adjust quite successfully. And that core 60% of our portfolio has continued to do quite well or perform okay. And then across the side of that, we've managed to add value with the options, the shorts, and the currency, which ultimately saw us deliver a positive return in September. And so from our point of view, we've stabilized the performance here. We are still in a drawdown. It is roughly 15% for the year. I'd argue that's at least 5% worse than I would like it to be. But when you look across the growth equity landscape, it has been, quite frankly, a dot-com style blow-up across a lot of the companies that we used to look at. And clearly, we're very thankful that our risk controls and our disciplines have basically pushed us to the sidelines earlier in the year, and that's sort of paid dividends as the year's gone on. As we look at this picture today, as I said, with the markets down where they are, and yes, potentially not quite bottomed yet, or maybe bottomed yet, we'll see, we actually think this sets up well. We think this sets up very well over the next 3 to 5 years. What's important here is to basically be happy to give up the first 5% of any rally to not lose the next 20% that potentially could be out there. This is a difficult period. It's clearly in a period of maximum uncertainty. It's not a period to be fully invested. But it's also important to stress that, you know, these macro periods can only last sort of 12 to 18 months tops. Eventually, we're going to know that inflation's under control. Eventually, earnings will be rebased. Speculation will be wiped out of the market. Governments will become rational, and you'll ultimately set yourself up for a great bull market. And so from that point of view, these years are clearly in front of us at some point. The key here is just to manage this last few months or weeks of the bear market to make sure that this situation doesn't get any worse. The other important thing to flag is it doesn't matter if you miss the bottom. Even if we miss the bottom like we did back in 2018, it's okay. You still have your average bull market lasts 64 months. 64 months, you have plenty of time to catch it up, as we did in 2020 and as we did in 2021. And so when we look at this picture, we ultimately think it sets up quite well to continue to produce those double-digit return numbers on a 3 to 5 year view. Granted, not everything's been perfect this year, but not everything's perfect every year. The reality is the processes that we rely on and the processes that we used have held us in good stead through this period, as they have in previous periods and as they will again into the future. And I'm happy to discuss that a bit more in the Q&A. So maybe heading back to the market and current positioning, I suppose the big question that we're getting excited about is where you're going to put the money. You know, this is obviously an opportunity-rich environment. We are going through a process here, as I discussed. It's a process that's going to leave us set up for what we think will be a very long bull market. And it's a very cathartic process. I know it's a little bit painful, but people should think of it like a remedial massage. It hurts a bit at the time, but it will set the economy up on a much better footing well into the future. And I think the anchoring of inflation expectations by the Fed is exactly the right thing to do. The slowing of the economy is exactly the right thing to do. And most importantly, you know, what are the opportunities this is going to set up for us into the future? And so from our point of view, this is a slide I showed you in January, and I'll show it to you again, and then I probably won't show it again next year. But as a growth investor, it's important to remember that, you know, we can look for revenue growth and we can look for free cash flow yield. Okay, so quite simply, you can buy a faster growing company, but you have to pay a higher multiple for it. You can buy a slower growing company, but you get a lower multiple for it. I showed you this slide in January. It was how to protect against rising rates and inflation. And so from our point of view, you know Jerome's going to go from here to here. And so we wanted to move back up this curve. Every single stock in grey is a stock we sold last year, either in last year or in January this year, sorry. So either in March or May last year or in January. And all of them got sold under our stop loss protocols. They fell from peak, we reviewed the position and we moved it on. So that's Square, Spotify, Atlassian, The Trade Desk, Twilio, all left the fund. When we got to January and things got worse, our triggers kicked in again and we moved on PayPal, we moved on HelloFresh, we moved on Snowflake, etc. And so all of this risk controls really did save us. A lot of these companies have fallen 30 or 40% since. It was very hard to sell them at the time, but ultimately our disciplines kicked in here. In the end, we've got the core portfolio I talked about, that 65% that's pretty much stayed the same since January, has basically been made up of these names and some new names I'll talk about in a second. These companies we feel still can grow through the cycle. We still feel that they have valuation support, and that ultimately, while they're down this year because of rates, their earnings are probably not going to move that much, even in a fairly dramatic slowdown. And so from that point of view, we feel comfortable with these. That's not to say we haven't made mistakes with things like NVIDIA and AMD. We have, they have actually had to downgrade earnings more than what we thought they were going to do. But within that, you've also got companies like Visa and Danaher that have also been incredibly stable. In terms of where we want to put the money next, the key thing we want to flag is we're probably not heading back out to the side of the curve anytime soon. From our point of view, within technology, the big structural changes in the world are still there, whether it's e-commerce or cloud computing or digital payments or internet advertising. But the key thing here is just to focus on the biggest guys. Your Amazons, your Microsofts, and your Googles, even they're struggling in this environment. But ultimately, they have valuation support. Ultimately, they can adjust their cost base. And ultimately, they have huge fortress-like balance sheets. And we do think you're getting a good opportunity to buy these monopolies, effectively, or duopolies, at very low multiples, low 20 times earnings. These are the ones we'd stay to. We would not move on to the fallen angels. I know the fallen angels have fallen a long way. I know 80% looks attractive from peak, but a company falls 90% by falling 80% and then halving. These companies are highly undercapitalized. They've been using a lot of shareholder capital to juice their growth rates. And that shareholder capital is just not going to be available. They're not going to be able to juice their growth rates. They're going to have to merge with each other. We do think that these new, out of those fallen angels, there'll be some new champions emerge, but they probably won't emerge to a year or two later. That's what we saw in the dot-com bust back in 2000. And this looks very, very similar for technology, at least. All the new capital we're putting to work in climate. We think the decarbonisation agenda is actually accelerating, and we think it's accelerating fairly dramatically. And this is the key area where you're actually going to get earnings upgrades in the next 12 months, regardless of what the economy does. And upgrades is effectively what's going to drive share prices. From our point of view, it's 50 trillion plus to decarbonise the planet. We've seen numbers as high as 100 trillion. It's a very diverse opportunity, whether it's in energy efficiency, renewables, or passenger EVs, batteries, etc. From our point of view, it happens no matter what. I know some people don't believe in it, but the reality is every corporate on the planet is set a net zero target. That means they need to address, if it's BHP, they need to address their vehicles, their buildings, who their energy supplier is. And if BHP is doing it, and Starbucks is doing it, and IKEA is doing it, and Nestle is doing it, and Walmart's doing it, then it's probably going to happen. And so from our point of view, this race to decarbonise the planet has begun and is really the next big structural opportunity. Two big things have changed this year in this area, and it's probably gone a little bit unnoticed because we've all been dealing with all the other problems in the world. The two big things that have changed is, firstly, obviously, Europe realizes they can't rely on Russia for gas. And even if the war ended tomorrow, I suspect they would not make friends and rely on Russian gas. And so from that point of view, Europe, gas prices are roughly 50 to 100 times higher than they were a year ago. They need to accelerate the transition. Secondly, Biden has got the Inflation Reduction Act done, probably the worst named act in history because it does the exact reverse of what it claims to do. But it is his entire climate agenda. His entire climate agenda is now set in stone for 10 years. It's in law and it can't be changed. And so that's 10 years worth of subsidies for clean electricity, for pollution, clean manufacturing, clean vehicles, rural development, etc. And so you've got the biggest economy in the world has just made the biggest commitment to decarbonisation possible and will now turn up at COP27 in Sharm el-Sheikh next month and basically point at Anthony Albanese and go, what's your plan? He'll point at whoever happens to be running the UK next month, what's your plan? And he'll continue to point at all these world leaders and effectively force more and more people down this path. The important thing about this subsidy plan is it's effectively provides economic incentives to allow something like this to happen. And this is just a good graphical picture of what needs to be done and why we think this is such a big opportunity. This is greenhouse gas emissions in the US today at roughly 5 billion tonnes. And this is the electricity mix or the power generation mix between natural gas, nuclear, coal, wind, etc. This is where it has to get to by 2030. You've got to get the greenhouse emissions down to 3 billion tonnes. And the way to do it is to change the mix. The other really interesting thing is the total amount of power you're supplying here in 2021 has to virtually double by 2030 because everything has to run off electricity into the future. So you're doubling the amount of power you generate and you're quadrupling the mix of renewables. And so what you end up with, is a 20x growth in renewables. And a 20x growth in renewables that's now entirely funded by the US government because the subsidies in place is to make this economically viable. That's great for developers such as Vestas and Siemens Gamesa, but it's also just great for simply utilities. NextEra has been in the front for a while. It's one of our better performing stocks this year. The reality is you now have to incentivize the utilities to do this transition in the same way you had to incentivize companies to build mobile phone networks or to build broadband networks. That incentivization is basically going to equal subsidies for existing power plants and subsidies for new renewable generation. NextEra is the largest producer of renewable energy in the United States, and you're basically going to get either 10 to 15% earnings growth per annum for a decade, and it's pretty much locked in. And so from that point of view, the earnings growth over here should ultimately drive the share price growth over time. The other big area we really like here is really in the transition companies, so the fuels that people sort of forget about. So there's the glamour fuels like solar and wind, and then there's the ones that actually are doing the heavy lifting like nuclear. Nuclear reactors are now incredibly important. If you go back to this slide here previously, you have to keep your nukes open to hit this target. From that point of view, Constellation owns the largest merchant nuclear fleet in the United States. That nuclear power is now more valuable. Why? Because you have to extend the life of those plants, so that increases your NPV. Secondly, you can produce hydrogen with that nuclear power. So the best way to make green hydrogen is with renewable power. The largest source of renewable power is nuclear. So you get to double dip the credits. Thirdly, if you want to build a new nuclear plant, the only place to build one is next to a current one. And fourthly, if Microsoft actually wants to buy that renewable power, they now have to pay a premium for it. And that premium basically goes to Constellation Energy. So these transition companies are basically being transformed by the changing landscape. They are legacy assets that become amazing assets. And we saw that happen with Constellation. The last one we'd just flag here really quickly is around LNG. So clearly Europe has a gas problem. Natural gas is sort of, orphaned somewhat, a bit like oil, in the fact that it's a fossil fuel, but it's very much a transition fuel. If you look at this slide I showed you earlier, the one you have to kill here is coal. Natural gas will fill the gap. All the LNG in the world, unfortunately, these days comes from the United States. Why? Because the United States can frack. They can frack for gas. They create cheap gas on the grid that companies like Cheniere just buy off the grid. They buy the gas off the grid, they put it into an LNG tanker and they send it to Europe, India or China and basically take the arbitrage. That arbitrage has seen their earnings grow dramatically this year and their share prices followed their earnings. And so from our point of view, this energy transition is the source of the earnings upgrades this year. It's probably going to be the source of earnings upgrades next year as well. And so from that point of view, this is an obvious place to deploy our current dollars. I'll skip that one in the interest of time, but I'm sure I'll come back to it. Just coming across, just the climate opportunity entirely. I just talked about the energy transition within clean energy. It's important to remember that there are other ways to play this, whether that's through clean transport, and that was the one I skipped over, which was our onsemi, which was our SON stock from last year, which has actually done well, surprisingly for a semiconductor stock in this environment, but it's just a reminder of how much the structural changes are actually driving these companies. And onsemi was a good winner for us. On top of that, you have things like energy efficiency, which will come into vogue here once the economy bottoms. And then lastly, the circular economy stocks. This is how we're playing this opportunity. It's a very broad opportunity and one we'll probably be talking about for a while. The other big area for earnings upgrades next year, and conscious, I just want to keep this short to give some time for questions. So please come back to us if you want to talk about it, is healthcare. Healthcare is an obvious place to look for upgrades in a slowing economy. This is just a good picture. It's the great virtuous circle, healthcare. This is just a good picture of what a pacemaker looked like in 1962, what it looked like a decade ago, and what it looks like today. It's fairly simple. You use technology to make products better. As you make those products better, you can charge more for them. Insurance will pay for them because they basically keep you out of hospital. And this is the virtuous circle that pretty much all the healthcare companies we look at and like to do. The one we're noticing more and more at the moment is pharmaceuticals. Pharmaceuticals, if you think back to the COVID situation, most of us had a Pfizer or a Moderna vaccine. It's interesting to point out that Moderna had actually developed that vaccine within 5 days of discovering COVID. So it took them 5 days to solve the problem. The next 2 years were spent basically getting it approved and getting it into everyone's arms. And how did they do it in 5 days? They used Amazon Web Services to run the data. They used NVIDIA programs to run it, and they synthesized the problem within 5 days. We are seeing drug companies solve big problems at an increasing hit rate. The one I'm showing you here is obesity. Obesity is not generally treated with pharmaceuticals. It's treated with diet and exercise. But the reality is if you can solve it, you avoid diabetes and you avoid all these other diseases on the other end of the problem. Only 2% of patients in the world are currently treated with pharmaceuticals. They're treated with something like this, which is a GLP-1. A GLP-1, without going into massive details, will basically inhibit glucagon release and effectively not make you less hungry. This is a product that some people on the call might know. It's used for type 2 diabetics, and it's now moving into the broader population. So instead of severely obese people taking it, which is roughly 13 million people, you're moving into like people who might be at risk of type 2 diabetes taking it, which is 131 million people. And so from that point of view, you have these drugs that are becoming increasingly successful and increasingly used more broader acceptance. That means they're effectively blockbuster multi-billion-dollar opportunities. This one we think is a $25 billion opportunity that is in front of us that's going to be split between 2 companies. The first of those companies is Novo Nordisk. It's listed in Denmark. This is the company it's basically Novo Nordisk and Eli Lilly have the two main products in the market. People will buy the product because they don't want to get fat, but insurers may even pay for the product to effectively stop you getting sicker later in date and to keep you out of hospital effectively. These are the earnings upgrades that Novo Nordisk is getting as this drug basically gets distribution around the world. It is very hard to get your hands on at the moment. As supply gets better, they should sell more. The earnings upgrades should continue, which ultimately will drive the share price. We see exactly the same thing as Eli Lilly. And on top of that, it's important to flag that more recently we have seen companies like Biogen and Lilly really even solve things like Alzheimer's in a very similar way with a preventative drug that you have to take for a long period of time. And lastly, you're hearing about Moderna. If you meet Moderna, they claim, and we'll see, that their COVID vaccine can also be synthesized to deal with things like cancer and malaria. So we expect this to keep happening, and these are really good earnings opportunities in a difficult environment. And this is just a quick insight into one of them. I'll skip through those slides. Happy to go back and talk about semiconductors in the Q&A if people want to. But from our point of view, this is where we've got the fund positioned as at the end of September. And from our point of view, this is something that appears in the quarterly every quarter and appears in the month and every month. And it's effectively what you're paying us to do. You're paying us to identify, as I said at the start, these big structural changes. These big structural changes will identify companies that get structural earnings growth. And that structural earnings growth gives you share price growth. That's your path to double-digit returns. Everything else is just smoothing the bumps. We spent a bit of this presentation talking about smoothing the bumps. But hopefully by early next year, we won't have to talk about bumps anymore. We'll be just talking about this stuff. From our point of view, healthcare and climate are the obvious places of earnings upgrades in 2023. Healthcare makes up roughly 12% of the fund today. Climate makes up roughly 12% of the fund. And you can see here we have 5 holdings with indicative positions like Danaher, Novo Nordisk, Eli Lilly I spoke about. Within climate, it's very much utilities and that Constellation Energy, those other transition fuels are sitting within our climate area. And we see lots of other opportunities here, as I showed you on the final slide. As the economy bottoms, these companies are going to become very, very interesting as they not only help decarbonize, but as we move into an upcycle. Below that, we have the normal areas that we've been in for a long time, like digital enterprise, emerging consumer, digital payments, and internet. All of these areas will be resilient. I think I'll probably get in the Q&A, even the Microsofts of the world are not immune to small downgrades. Those downgrades obviously affect the share price, but they're tiny in comparison to what you might see from other sectors as this goes on. From our point of view, we think these companies remain very resilient. Should bonds peak, they should actually rally because they have that structural earnings growth we're looking for. But over time, at the right price, we'll continue to add to these over time because we still think they're great opportunities on any sort of medium-term view. Their opportunities just quite frankly been shifted to the right a little bit. And so at that point, I'll probably pause and check with you, Steve, as to where the questions are going to go from here. But I've spoken for exactly 10 minutes longer than I thought it said I was going to speak to. So where do you want to go next?
That's no problem at all. Thanks, Nick, for your presentation. We've had a couple of questions coming through. So we've had a couple of questions on NVIDIA. Can you please touch on how the NVIDIA thesis has evolved in recent months?
Yeah, thank you. So this has happened a bit this year. So for those of you who remember, we like semiconductors. We have for quite some time. This is semiconductors in 1970. This is semiconductors today, and this is where we think they can go to. I think most people on this call recognize that compute power is important to the future of the planet, and the people who make the best semiconductors in the world are clearly, very important. It's important to notice along the way you have these down cycles, like you had one here, you had one here, you had one back in 2019. We are clearly in one today. And so from our point of view, nothing in our structural thesis around NVIDIA and our structural thesis around AMD and accelerated compute has actually changed. Nothing's changed. The only thing that we noticed or that happened to these companies, as you can see here in NVIDIA, these earnings upgrades that were our structural thesis did include some pull forward. There was pull forward within their gaming business, and there was some pull forward in some of their other areas. The second thing that's unfortunately happened is the US government now agrees with us that these companies are the most important companies in the world because they won't let them sell their products to China. And so these China bans are creating some uncertainty around NVIDIA. From our point of view, we've managed the position size since the start of the year under our stop loss protocol. So it started the year as like a 4% position, and it's been below 2% now for at least 6 months. We are still there in smaller size We still think this company looks sensational on any sort of 5 to 10 year view. But as has been the case all year with all of our stop loss protocols, the reality is if the facts change, and the facts have changed around these China lockdowns, that we should step to the sidelines. We should just step back. It is an absolute return fund. Our goal is not to create these huge losses. We're not 100% sure how this is going to turn out. And so we have reduced the position size to reduce the risk. But in terms of the thesis, nothing's really changed here. It's just having a bit of an analyst, a tough time. Last thing I'll just say about NVIDIA, this has actually happened before. It happened here in 2018 to 2019. And to be fair to we are a bit surprised that they've managed to make the same mistake again, to basically overcook estimates and to overcook the demand profile. We spoke to them more than 6 times this year. First 5 times they said everything was fine, and the 6th time they said, actually, we've got a problem. And we must have asked them about the same problem the first 5 times as well. And I think this just points to the lack of visibility out there in the market. A lot of these companies don't really have visibility on where their earnings are going to go. And NVIDIA has been a good case in point. And so from our point of view, one we've had to manage, but definitely one we've had to put our hand up and say that probably wasn't the best place to be at the start of the year.
Okay. So we're in the middle of US earnings season right now. So have you got any comments maybe on Facebook? And we might even talk a bit about Microsoft and maybe potentially, what do you read into Microsoft's results for the broader economy?
Yeah, so maybe just to jump back to where I was before, sorry if I'm jumping around. So most people who've heard me speak before or have followed our products would know that we've been following these big structural trends for a long time. E-commerce goes from here, accelerates through COVID, and then goes to here. And all of these companies have been, fabulously successful investments over any sort of time horizon. What they've had to deal with in the last 12 to 18 months is they basically overgrew through COVID. Through lockdown, we spent a lot online. We signed on to a lot of cloud services, et cetera, et cetera. So a lot of these outside of the Visa and MasterCard, they overgrew through COVID, and they've been dealing with those comp effects. On top of that, many of these companies probably overspent as they were overgrowing. And now they've walked into a slowdown and they need to manage that cost base. And so what you saw from Google overnight was the slowing economy on their advertising line. That makes sense. Their revenue line's not going to go negative here, but it's going to slow, but their cost base is still too high. And so their margins came down. And so they need to adjust that cost base, and we think they can. You saw a very similar thing happen at Microsoft. So you end up with a small sort of single-digit downgrade to earnings. And you may see a similar thing with Amazon, but Amazon's been working at this for longer than the other two. So you never know, they might have got that cost base in line. And so from that point of view, this is an adjustment. The balance sheets are fine. These companies' earnings will continue to grow. The structural trends are just there, but it's not a surprise to us that they did small downgrades overnight or this week to their earnings. And more importantly, it's probably already factored into their share prices because most of their share prices are down 20 or 30% this year. The interesting one that's different and the one that we don't own is Facebook. And Facebook's the one who's not trying to spend less. They're actually going to spend more. And so this is this narrative around Mark obviously Zuckerberg diving into the metaverse. And overnight, the stock's down 20% after market because he's put the CapEx up. And he's put the expenses up because he's basically investing for growth in the metaverse, and shareholders don't believe him. And this is ultimately a problem with governance, I suspect, at Facebook. But Mark's a genius. It might work out. But right now, the market doesn't want to see him spending quite literally $130 billion next year in CapEx and expenses at a company whose revenue is slowing. And so the jaws of Facebook are closing obviously quite dramatically, whereas at the other companies, they're going the other way, trying to adjust it. And so that's why we don't own Facebook, but we do still own the other ones.
Okay. A couple of questions, Nick, on Tesla. So, has your thesis on Tesla changed at all post earnings?
So from our point of view, we are small holders of Tesla. We do own it in the climate fund, but and then small holders in the other fund. We're ultimately seeing this as an opportunity we've always liked Tesla, basically for the shift for electric vehicles. We've always been fans of the company and how they've executed. Our problem has always been the valuation. The valuation should or hopefully give us a chance to make a better position at some point here. But from our point of view, this shift to electric cars is what I'm showing you here. This is the car market. This is the shift to electric cars. is one of the great S-curve opportunities out there. You know, this is clearly an area where earnings growth, the S-curve will outrun the macro in the years ahead. And so Tesla, we think, is very well positioned to execute this. The stock is basically down to 30 times earnings now. And if we could get it somewhere in the 20s, you know, that would be an interesting risk reward proposition. And the good news is Elon generally finds something stupid to do to give us that opportunity. And in this case, he's done it with Twitter. And that could give us an opportunity to invest in what we think is the premier electric car company in the world today. But not a big investor today.
Okay. Just another question on your stop losses. So Nick, you often talk about stocks that have triggered. How have the stop losses helped in 2022?
Yeah, and so I think this is, you know, I showed you the slide earlier, but I'll just show you one more. This is, I suppose, the difference between us and most growth managers out there. And this is why, you know, we've versus growth managers, we've had a slightly more successful year. And the key thing to flag is that, you know, the reality is we know that the world is full of few great companies and thousands of mediocre ones. Okay, so you're going to make mistakes. You should just accept that before you even start the job. And our job is, most importantly, is to identify these areas of structural growth and identify the winners. And if you do that well, you know, you find these great stocks. You find the Amazons, you find the Teslas, you find the Danahers of the world, the ASMLs of the world that have these huge structural earnings growth periods when that earnings growth equals structural share price growth. But the problem is you're going to make mistakes. And so we have a very formalized way of dealing with it. Any stock that falls 20% from peak or from cost is subject to a review. We review that position. We don't have to sell it. And we'll generally probably decide all to keep it. But we have to review the whole investment case. But if we do keep it, we can only keep it for 30 days. And in 30 days' time, you review it again. And in 30 days' time, you review it again. And eventually you realize that you've made a mistake. This is how we got out of the China stocks all the way back in March 2021. And then finally sold our last one in May 2021. Why? Because the more we looked at it, the more it kept triggering, the more we realized that the government had actually changed its view. And since then, those stocks have fallen, you know, 60, 70%. This is, again, as I showed you on this slide here before, you know, why we stepped to the sidelines on HelloFresh. You know, I've been very public about liking HelloFresh. We made a lot of money out of HelloFresh. It fell 20% from peak. We looked at it and we sort of said, you know what, HelloFresh is going to have a tough year in 2022 because it's cycling its COVID comps. If food costs are going up and it's tough to get labor. So why don't we just step to the sidelines? We still like the company. But let's just step to the sidelines because basically there's not much upside to our price target left and we're trying to squeeze the lemon a bit too much here. Or there's something on the horizon here that we're not quite sure about. And so why don't we just manage the risk here? And so this is what we will do that other growth managers won't do. And it's ultimately what saved us because every single one of these stocks that we sold out of has fallen sort of 30, 40% since. And I can assure you, it's not an easy process to sell a company 20% below where you could have sold it. It's not an easy process to go through the acceptance that maybe the best returns have been made here, or maybe the facts have changed. But it's a very important part of our process because it allows you to react to when things do change. And things clearly have changed this year, and we've clearly had to react to it. And the way we reacted to it after the first quarter has ultimately brought us back into a really good position to ultimately invest in these companies at much, much lower valuations and ultimately generate the double-digit returns that we're promising our clients.
Okay, maybe one just final question, Nick. How meaningful is nuclear going to be over the coming decades in energy production in your view? There are countries that are still looking to shut legacy plants down. Is there a broader mindset shift expected given the historical disasters which feed the political debate? Yeah, so obviously this is something that we've all had to get over, and we got over it about a year ago when we started looking at nuclear companies. From our point of view, the climate problem has got so bad that it is all of the above from here. So whatever can help, you should invest in. Even the Europeans outside of Germany have effectively stayed on board nuclear. The Japanese, who were going to shut their plants, are going to keep them open. The US has just offered huge subsidies to keep theirs open for longer. And so from our point of view, nuclear is integral to the solution. The problem is you can't really build new ones. It is very hard outside of emerging markets. It takes a very long time. I know there's modular nuclear, small scale nuclear, and hopefully that comes along.
But I would give exactly the same argument to natural gas. Natural gas is being treated like a product that's going to disappear at some point in the future. It's not. We're going to need it for at least 30 years. Public enemy number one is coal. Public enemy number two is oil, and then methane and others, and then eventually you end up at natural gas. And so from our point of view, I think these transition fuels, and I think nuclear is incredibly important, but I think gas is going to be super important. And that creates the opportunity for companies like us to invest, because some people haven't got over that hurdle, and that's the opportunity that we find. And yeah, nuclear is by far the best performing stocks in our fund this year. And if we could find more, we would buy them.
Okay, actually, I'm going to give you one more question, Nick, because the question just popped up, which I think is a good one to answer. What is Munro's outlook on chips and recent developments in the semi space?
So yeah, and do give me a chance to conclude here, by the way. Look, from our point of view, semis has obviously been frustrating for us this year. It's the one area where we didn't manage the risk effectively enough at the start of the year, and it's a source of a good chunk of our losses. Why did that happen? Well, because we just think on any sort of medium-term view, these companies are incredibly important. But the reality is the market is much more obsessed with next 12 months earnings than it is with the next 5 years earnings. And that's fine. That's what happens in bear markets. And you know, we should have been more appreciative of that. But on any sort of medium-term view, you know, the China-Taiwan tensions, the fact that the US is trying to bar the Chinese from buying NVIDIA and AMD chips tells you everything you need to know. These companies are the most important companies, we think, on the planet. They hold the keys to human progress, which is computers getting faster. Every company in the world wants to invest in computers getting faster. Why? Because it's how you beat your competitor. Whether you're an autonomous car or a retailer or a healthcare provider, that's how you win. And so from our point of view, a lot of value will transfer to them over time. Unfortunately, the semi-cycle is still the semi-cycle and it still exists. These little bumps are going to keep happening, but there's nothing to suggest that we're not on our way to $1 trillion plus in semiconductors. And we think these are the companies you want to hold coming out of this. And they're definitely the companies that have fallen enough today to make a start on some of that. And we've had to manage it all year, but our medium-term view is completely unchanged.
Okay, excellent. Well, I'll now hand over to you again for conclusion.
Yeah, sorry, I just wanted to remind everybody, look, at the end of the day, look, I understand it's been a bumpy period. We've had to make some adjustments through the year to account for a macro environment that's obviously significantly worse than what we thought. Do not get too hung up about an upcoming recession, okay? Recessions are normal. They happen all the time. The equity market will price them in. It always does. It can't, you know, even though the economy will continue to slow next year, the market will have it priced in at some point, and may even have it priced in today. And so from that point of view, macro can only really dominate the narrative for sort of 12 to 16 months, to 18 months, sorry. At the end of the day, companies will go back to focusing on earnings growth, and earnings growth will drive share price growth. That's the journey that we talk about at Munro Partners. And I just wanted to flag, importantly, you know, within this deck is lots of information, but also on our website is lots of information to help you understand that that's the journey that you're on, and that these are the companies that are at the forefront of these structural changes. That structural changes equals earnings growth. That earnings growth will equal share price growth, and that's ultimately going to get us to our double-digit returns. Most of the hard work, I think, in this bear market has been done. There may be some more to go, but ultimately we just want to be prudent through this last period before ultimately setting us up to what we think is going to be a great period for growth investing, and a period that we're actually truly excited about. And I really appreciate people dialing in and listening to what we have to say.
Terrific. Thanks, Nick. I appreciate the presentation. Ladies and gentlemen, thank you for taking the time. We hope you found the webinar today of value. If you have any questions from today's session or require additional information, please contact your GSFM key account manager, and please go to as Nick said, please go to munropartners.com.au. They've got some, as Nick said again, regular updates, podcasts, insights, etc. It's a great resource. So I'd encourage you all to visit the website. Our final webinar of the year will be next month with a dedicated climate change webinar. Invitations for this webinar will go out early next week, so we hope you can attend that. Finally, on behalf of Munro and GSFM, thanks for your terrific support. It's been great over many years now, so it's very much appreciated, and thanks again. On that note, we look forward to speaking with you all again soon, and please enjoy the rest of your day. Thank you.
Thank you.